Do you want to increase your credit score from 500 to over 800 quickly? Understanding what your credit score means is the first step. Often, we hear about credit scores in conversations around finances. But what exactly is a credit score? It's a three-digit number that lenders use to evaluate the risk they take when they lend you money. Your credit score is like a financial report card reflecting how well you've managed your debts and paid your bills. Now, why is it important? Well, a high credit score can unlock doors to many financial benefits. It makes it easier for you to secure loans with lower interest rates, rent an apartment, buy a home, or even land a better job. In short, your credit score is a key that can open up a world of opportunities for you. So, how is it calculated? You ask. Credit scores are computed using a formula that includes different factors: your payment history, amount of debt, length of credit history, new credit, and the types of credit you use. Each factor carries a specific weight. For instance, your payment history and the amount you owe together make up about 2/3 of your score. Now, let's talk about the ranges. Credit scores generally fall into 5 categories: poor, fair, good, very good, and excellent. A score under 580 is considered poor, while anything over 800 is excellent. If your score is around 500, don't worry. It's not a life sentence. It's just a starting point. Remember, understanding your credit score is like knowing your starting line in a race. It's important, but it's just the beginning. There are many steps you can take to improve your score and make your financial dreams a reality. Now that we know what a credit score is and why it's important, let's delve into ways to improve it. So, you've got a low credit score, but why? Let's uncover the reasons. One of the most common reasons is missed payments. Your payment history makes up about 35% of your credit score. That means every late payment, skipped payment, or defaulted loan is a heavy blow to your credit health. It's like a game of Jenga. One wrong move, and the whole tower could come tumbling down. Next, let's talk about credit utilization. This is the percentage of available credit that you're currently using. It's a bit like going to an all-you-can-eat buffet and piling your plate high with food. Sure, you can eat it all, but it's probably not the best idea. Ideally, you should aim to use less than 30% of your available credit. If you're maxing out your credit cards or constantly hovering near your limit, your credit score can take a hit. Another common culprit is a short credit history. In the world of credit, age is more than just a number. The longer your credit history, the more information lenders have to assess your credit worthiness. If you're new to credit, or if you've only recently started using credit, it's like being a rookie in the big leagues. You've got potential, but you haven't had a chance to prove yourself yet. Lastly, if your credit portfolio lacks diversity, it could be dragging down your score. Think of your credit portfolio as a financial garden. If you only plant one type of seed, your garden won't be as robust or resilient. Similarly, having a mix of credit types, like credit cards, installment loans, and a mortgage, can strengthen your credit score. But don't despair. Understanding these common reasons for a low credit score is like turning on a light bulb in a dark room. It can help you navigate towards a brighter financial future. Identifying the cause of your low credit score is the first step towards improving it. Ready to start your credit repair journey? The first step is to get a copy of your credit report. Now, you might be wondering, where do I get this report and how much does it cost? Rest assured, every individual is entitled to one free credit report every 12 months from each of the 3 major credit bureaus, Experian, TransUnion, and Equifax. To obtain your credit report, visit annualcreditreport.com. This is the only authorized online source for you to get a free credit report under federal law. You can also call 1-877-322-8228 if you need personal help. Once you have your report, what should you be looking for? Well, your credit report contains all the details about your credit history. Any credit cards, loans, or maybe even mortgages you've ever had. It also includes how much you owe and whether you've made your payments on time. Now, this is the crucial part. You need to ensure that everything on your report is accurate. Mistakes happen. Maybe your lender reported a missed payment that you actually made, or perhaps your personal information is incorrect. These errors can drag your credit score down. So, if you spot any inaccuracies, you have the right to dispute them. Disputing errors on your credit report involves writing a letter to the relevant credit bureau. You'll need to specify what information you believe is inaccurate and provide any supporting documents. The bureau is then required to investigate, which typically takes 30 days. Remember, repairing your credit isn't just about fixing mistakes. It's also about understanding what factors are influencing your credit score. That's why it's so important to review your credit report at least once a year, even if you're not planning to apply for credit in the near future. With your credit report in hand and errors disputed, you're ready for the next step. This journey might seem daunting, but remember, your efforts will pay off tremendously, and your financial future is worth it. Debt is a significant factor in your credit score. It's time to tackle it head on. Now let's talk about strategies for paying off debt. One popular method is the snowball method. This approach involves paying off your smallest debts first while making minimum payments on larger ones. As each smaller debt is paid off, you roll the money you were paying on that debt into the next smallest balance. It's like a snowball rolling down a hill, gaining momentum and size as it goes along. This method can provide quick wins and help keep you motivated. On the other hand, there's the avalanche method. This strategy involves paying off debts with the highest interest rates first, while making minimum payments on the rest. This can save you more money over time, but it might take longer to see progress. Both methods have their merits, and the best one for you depends on your personal circumstances and temperament. If you're the type who needs to see progress to stay motivated, the snowball method could work for you. If you're more concerned about saving money in the long run, the avalanche method might be your best bet. But regardless of the method you choose, the most important thing is to make your payments on time, every time. Late or missed payments can have a significant negative impact on your credit score. So, set up automatic payments, set reminders, do whatever you need to do to ensure you're making those payments. Remember, reducing your debt isn't just about improving your credit score. It's also about reducing stress and gaining control over your financial future. As you pay down your debts, you'll likely find that you have more money to save, invest, and spend on the things that truly matter to you. So, start today. Make a plan, stick to it, and watch your debt decrease and your credit score rise. With consistent effort, you'll start to see a lot of progress. Reducing your debt is a surefire way to see a quick boost in your credit score. Next on our list is credit utilization. This is the ratio of your credit card balance to your credit limit. Now, what does this mean for you? It means that the lower your credit utilization ratio, the better it is for your credit score. This ratio plays a significant role in determining your credit score, and so it's crucial to keep it as low as possible. So how can you achieve a lower credit utilization ratio? Well, one of the simplest ways is by paying off your credit card balances monthly. By doing this, you're showing credit bureaus that you're capable of managing your credit responsibly. With each payment, you're not just reducing your debt, but you're also lowering your credit utilization ratio. Now you might be thinking, what if I can't pay off my entire balance every month? Don't worry, you're not alone. Many people face this situation. In such cases, try to at least pay more than the minimum required payment. This will still help decrease your credit utilization ratio over time. Another tip is to increase your credit limits. Yes, you heard that right. By increasing your credit limit, you're reducing your credit utilization ratio without necessarily changing your spending habits. However, this strategy comes with a caveat. It's crucial that you don't see the increased limit as an invitation to spend more. Remember, the goal is to lower your credit utilization ratio, not to increase your debt. Lastly, consider using more than one credit card. Spreading your charges across multiple cards can lower your credit utilization ratio on each card. But be cautious. This strategy requires discipline to ensure you do not overspend across multiple cards. So, to sum up, lower your credit utilization by paying off balances monthly, increasing credit limits, and using more than one credit card. And always remember, the key is to show that you can handle your credit responsibly. By lowering your credit utilization to 25% or less of your total available credit, you're showing lenders that you can responsibly handle credit. And that, my friends, is a surefire way to boost your credit score. A longer credit history can work in your favor. Let's look at how to build it. Now, you might be wondering, how can I lengthen my credit history? Well, there are a couple of strategies that can help. The first one is simple. Keep your old accounts open. Here's the thing. Your credit history is partly based on the age of your oldest account and the average age of all your accounts. So, even if you've moved on to a better credit card or loan, it's often a good idea to keep that old account open. Just remember to manage it properly to avoid any potential pitfalls. Another strategy is to become an authorized user on someone else's credit card account, preferably someone with a long history of responsible credit use. This can be a parent, a spouse, or a close friend. Once you're added as an authorized user, the account's credit history can appear on your credit report. This can give your credit history a significant boost. But remember, you must trust this person entirely because their credit behavior will directly impact your credit score. If you're new to credit, consider a secured credit card. Secured cards are backed by a cash deposit you make upfront, which is usually equal to your credit limit. They're designed for people with no credit or poor credit. The best part is, most secured cards report to all 3 major credit bureaus, helping you build a credit history. Lastly, consider a credit builder loan. These loans, offered by some credit unions and banks, are designed to help individuals build credit. Payments are reported to credit bureaus, and your loan amount is typically kept in a locked savings account until the loan is paid off. In conclusion, lengthening your credit history isn't a quick process. It requires patience and consistent good habits. But remember, a longer credit history gives lenders more information about your borrowing habits, which can help increase your credit score. Diversifying your credit can show lenders that you're capable of managing different types of credit. Now, what does diversifying your credit really mean? In simple terms, it's about having a mix of credit types under your name. It's like a good salad. You don't want just lettuce, right? You want some tomatoes, cucumbers, maybe some croutons. Similarly, a healthy credit portfolio isn't made up of just one type of credit. Here's your credit mix recipe. Start with a base of revolving credit. This is your credit cards, your home equity lines of credit. These are types of credit that you can borrow from, pay back, and then borrow from again. Next, sprinkle in some installment loans, like car loans or student loans. These are loans with a fixed repayment term. Finally, top it off with a mortgage, a loan taken out to buy property or land. This mix of different credit types demonstrates to lenders your ability to manage and repay various types of debts. It's like showing them you can juggle. But instead of juggling balls or flaming swords, you're juggling financial responsibility. Now, it's important to remember that this doesn't mean you should rush out and apply for every type of loan under the sun. Each credit application does have a temporary impact on your score, and you should only take out credit that you need and can afford to repay. The credit mix makes up about 10% of your FICO credit score. It might not seem like a lot, but every little bit helps when you're aiming for that perfect score. Lastly, remember that diversifying credit should be strategically done. It is important that you build the right credit portfolio, and it's not something that can or should be rushed. Diversifying your credit can be a strong strategy to boost your credit score. So let's start juggling, but remember, only juggle what you can handle. Improving your credit score can be a sprint or a marathon. If you view this entire video and take action immediately, your credit score will increase fast. If you are not consistent in your efforts, improving your credit score will seem like a long marathon. In the journey of credit score recovery, there's no room for complacency. Regularly checking your credit report is a must. This isn't just about tracking your progress, but also ensuring there are no errors that could be negatively impacting your score. If you spot any discrepancies, don't hesitate to dispute them. Remember, the aim here is accuracy. Consistent payments are another crucial aspect. Every on-time payment you make is a step towards a better credit score. From your utility bills to your credit cards, make sure you're not missing any payments. Late payments can drop your credit score by a large number of points, so set up automatic payments to avoid any slip-ups. Now, there are many benefits to obtaining an excellent credit score of 800 or higher. Lenders will see you as less of a risk, so focus on taking those consistent positive actions that will quickly improve your score. You must also resist the urge to apply for new credit too frequently. Each application can result in a hard inquiry on your credit report, which can temporarily lower your score. So, it's best to apply for new credit sparingly and only when necessary. A final note: you must continuously pray for the discipline to stay motivated. You will soon be able to celebrate a lot of victories along the way, like paying off debts and seeing increases in your score. These moments will be proof that your efforts are paying off. So, stay the course. Regularly check your credit report, make your payments on time, and practice discipline. It's not always easy, but remember, with God, all things are possible. Your credit score will climb higher and higher. We've covered a lot of ground today. Let's recap the steps to increase your credit score from 500 to over 800. First, we started by understanding the importance of credit scores. It's more than just a number. It's a reflection of your financial health and trustworthiness to lenders. Then we looked at why your credit score might be low. We learned that late payments, high credit utilization, and a short credit history can all contribute to a lower score. But don't worry, it's never too late to start repairing your credit. Starting the credit repair journey involves getting a clear picture of your financial situation. This includes knowing how much debt you owe and to whom, and making a plan to pay it off. Remember, every little bit helps. Even small payments can make a big difference over time. Next, we focused on lowering your credit utilization. This means using less of your available credit. A good rule of thumb is to keep your credit utilization below 25%. This shows lenders that you're responsible with your credit and can manage it well. Building a longer credit history and diversifying your credit were our next steps. The longer your credit history and the more diverse your credit types, the better. This shows lenders that you have experience managing different types of credit. Lastly, we stress the importance of consistent monitoring and praying for discipline. Improving your credit score does not have to be a long and daunting task. Just follow the instructions in this video and your credit score will soar. Regularly checking your credit report for errors and keeping track of your bills are necessary to continue increasing your credit score. Remember, monitoring your credit score is a journey that never ends. Keep working at it, and you'll see your score rise and stay above 800. Thanks for watching. Contact me if you need assistance with improving your credit score. Also, remember to like, share, and subscribe.